All right, Justin. Well, we finally made it. We're at the, let's just say the end, I guess, the end of a series. Certainly not the end of some learnings. We're not
hold your applause.
Yeah, we're not wrapping up the podcast, so don't cry and go away yet. But we are wrapping up this series and really this topic we've been tackling, which is pursuing a better investment experience. And our hope is over the past few weeks and episodes, hopefully you guys have taken something away. We've gone over a lot. We've gone over really, some of the big lessons: embracing market pricing. Don't outguess the market. Let's not pretend that we're smarter than we are. Let's actually look at the data. Let's resist chasing past performance. We also know that doesn't work. And let's just gain the rewards, right? Let's let the markets actually work for us. Let those markets continue to build our wealth for us. Consider drivers of returns. Don't just passively kind of close your eyes and throw your money in and say, hey, I'm not going to look at it. But really look at the data, find out where those areas are that maybe you can have a little extra exposure and make sure to allocate there.
Don't pick stocks though.
Don't pick stocks. Yeah, very clear. Hopefully this isn't your first episode and took that away. Smart diversification, diversify globally. Those are lessons that we've learned time and time again. Not always the easiest to implement, but make sure you're doing that. And then don't let all this noise really creep in, right? Like the headlines that are going on, the Jim Cramer's buy, sell, the Goldman broker that's calling you and saying they got the next hot IPO. Like it's all nonsense, right? And so don't allow those big kind of news headlines, those things that, are motivated by capturing your attention and selling you ads or selling you some product driven type sales pitch. So let's stay away from all those. And so today's episode, what we want to hit on is, somewhat a culmination of those lessons, but then also the big one, right? Focusing on what you can actually control in this process. So maybe start there for us, Justin, maybe just unpack a little bit. We start thinking about the things that we actually can control in this process. What would you point to?
Well, first and foremost, I think it goes back to everything we've talked about, right? That is something you can control. You can make an active decision whether or not to tune out the noise. But really what we're getting at when we say that is a more active component on what you can control, right? Kind of, I guess, by definition, if you will. Taxes, those are a big thing. So be aware of the tax impact of your decisions. Expenses, really, very much related to taxes in certain circumstances, but expenses can come in the form of expense ratios that you pay a mutual fund or an ETF. Most products like that have expenses. They're not all bad, but be aware of them. Make sure you're keeping those as low as possible because they eat into your returns. Your overall financial structure, how you're defining success. These are all really, really important things to think about. And these are things that you can control in your day-to-day investment experience and really worth taking a step back to properly understand, but in some cases also really properly define, like what is success? What is your financial structure? What should your resulting portfolio look like? All of these things get into this idea of what you can control. And if the beautiful thing about that is if you focus on that, it gives you more confidence and a greater ability to deal with these things that you just highlighted, Brandon. Don't outguess the market, manage your emotions, because there's this really well-rounded foundation, or again, we use the term financial structure, but plan in place too. You could summarize it as having that sound plan in place that gives you that foundational understanding to say, oh, I know why we're doing this because there's an answer on the other side of it, as opposed to just sticking your finger up and say, oh well, the market's doing XYZ. I'm going to react to that because of something I read, on online or heard from a buddy on the golf course or at a cocktail party, whatever the case may be, right? Those reactions never say never, don't generally end up as a very sound, repeatable investment process, right? So that's really what this culmination of controlling what you control is to take a step back, do the homework, understand what's important, understand what detracts from returns, things that we've hit on throughout this entire series, and then implement actively a process that takes all of this into account and really gives you a more robust, higher expectation of success going forward.
I think those are great points. And I think maybe even framing it one way, I think would be helpful for whoever's listening, Justin, is probably it's an end client listening or prospect or somebody hopefully that's working with an advisor to implement these things. But you hit on one thing, like low costs. So, when I'm talking with clients or prospective clients from time to time, the question is, okay, so we just optimize for cost and what goes into that? You hit on expense ratio, but there's trade costs, there's, tax efficiency costs, turnover costs, all those types of things, right? So it's not always just go pick the lowest cost ETF. There's nuance in that.
There totally is. And it goes back to looking at the data. So that it's a great question to ask when you're talking about, hey, let's just control for cost. The primary reason we do that is because you look at the data and higher cost does not correlate with bringing you higher returns. In fact, the exact opposite is true. So cost at a minimum, let's talk about expense ratio. So that's the manager fee. That is directly correlated with poorer outcomes. It really is. And so, that's an easy thing for us all to understand. But then we get into things like taxes, and you said trading costs. Those are costs, those are frictions within a portfolio. When you buy and sell things, there is always a cost, even if, we live in a world now where trade commissions largely are free within most large brokerage firms or online platforms and whatnot. There's still an embedded cost. There's something called a bid-ask spread, and I'm not going to get into the weeds too much there, but there's a difference between what someone's buying it for and what someone's selling it for. And that difference is an implicit cost that doesn't show up in anyone's rate of return. It does get siphoned off as a frictional cost within investing. And the more times you do that, the more you're losing, you're seeping money into the system and not keeping it in your pocket. Those taxes, that's a more straightforward one, but these things add up over time, especially the more turnover you have. And at the end of the day, you're left with less in your pocket. And even almost more importantly, you're left with less in your portfolio to continue to compound on itself time and time again into the future. That's what we mean by cost. It's not one simple metric, although controlling for pure management fees is a pretty strong signifier of what generally should be a better investment return going look on a go-forward basis, all things being equal, right? But there are these additional things to be aware of, taxes, trading costs, and whatnot, that really do detract from your overall rate of return.
Yeah, I think that, so to stick along this theme, I think this is maybe a great thing. If you do have an advisor, you're thinking about hiring an advisor, great question to ask. How do you control for costs? What goes into that? How do you select positions for the portfolio that are going to be in my best interest from a cost standpoint, from a tax efficiency standpoint, certainly, and to kind of continue down those themes, right? Some other things that you can control for, your advisor certainly should be controlling for, is global diversification. Right. We hit on that. Making sure that we're disciplined through the ups and downs. We're going through the current market environment. You want to make sure that your advisor is really sound, right, in understanding there's a lot of noise out there. They're not going to dial for dollars every time there's a market movement and try to, buy the dips and sell the highs and this type of thing. It's a typical wirehouse sales tool that they teach you, but stay away from that type of stuff. That's within your control to make sure that your advisor is controlling for those as well. But then overall, I think you hit on it, Justin, when we bring all of this and we tie a big bow on it, you as the end client or the end investor always are in control of your financial structure, right? Your advisor can only do so much when it comes to this. Implementation, they better be an expert. They better know how to do all these things, but you have to be a real active participant, right, in the financial structure at the end of the day.
Yeah, the way in which we view that is your financial structure is a true, unique representation of who you are. Some people might have dominant human capital where they're still earning, they're in their earning years, if you will. Other people have financial or realized financial capital that dominates their financial structure. And then making sure that those assets, whether it's realized or unrealized, are then built or managed in a way that is unique to you and specific to you and your priorities, your goals. That is how we define success. Building a portfolio that has the most robust or highest expectation to meet your goals at the end of the day is our benchmark. That's how we define success. And if you can combine that custom portfolio with a really well-defined investment experience that we've been talking through this entire series, right? All these elements of focusing on what you can control, global diversification, being aware of taxes, managing your emotions, et cetera, et cetera. That's kind of what I was alluding to earlier. All of this brought together is just a really, really powerful outcome that is not sacrificing returns, actually, at the end of the day. In fact, we feel very strongly and confidently that putting this all together, as we've been discussing, leads to an overall better investment experience, which is not just some sort of touchy-feely statement. It's a more robust, more confident way in which you can go about managing wealth.
Yeah, absolutely. I think when you sit down and what we've designed our company to, and the types of clients that we try to work with, right, are those that think about the potential or have the ability already to have multi-generational wealth and really frame everything through that context. If you're trying to win the lottery or kind of hit it big, it's probably not the right approach, what we've been talking about for the past few weeks. But if you're trying to maximize your wealth for your lifetime, for future generations, I'd challenge you to find a more robust way to go about it and a more sustainable way to go about it. You're not going to have to ride those highs and lows. You're going to have a lot of confidence in your overall financial structure and how things are planned for. So hopefully this series has been helpful. We'd love to hear from you. As you know, you can shoot us a text. That phone number again is 602-704-5574. We'd love to hear your feedback. If this series was helpful, if we should do more stuff like this, that'd be awesome. But until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.